Hello friends, in the last two videos we've actually been talking about how the Reserve Bank of India, or for that matter any of the central banks of the world, intervene when the economy is slowing down. Today we are going to talk in terms of what has been described, especially in America, as quantitative easing. Now this is something which is not defined, but we've done a bit of a research to come to a conclusion as to what quantitative easing means to the people who are in the business of central banks and banking regulation and interest rates. In the last two videos, we've talked about the open market operations, and then we talked in terms of monetizing the deficit, which popularly is called printing of notes. But today we are going to be talking in terms of quantitative easing, which is something which is used more of an exceptional type of a measure by the central banks and not to be used in routine. It is something which in the Indian scriptures is called the Brahmastra. So literally the ultimate remedy which the central banks have to trigger the economy when it is going through a slowdown mode. It was very popularly used by the US Fed in the year 2008 when the global meltdown relating to the housing and mortgage securities and so on happened, and various brokerages and huge houses, they literally collapsed overnight. Now, how is quantitative easing any different from open market operations? As we learnt earlier, in open market operations, the central bank purchases the government securities normally held by the banks, as a result of which the banks get more money into their coffers. They would therefore lend and kind of boost investment. And moreover, when you are purchasing securities, money is coming into the coffers of the banks, the interest rates would also automatically go down because you're pumping cash and liquidity into the system. Now, what happens in case of quantitative easing? The central bank traditionally can lower the interest rates, the rates at which the Reserve Bank of India lends to the bank overnight. So if there is any shortage of cash with the banks, the overnight lending rate, the repo rate as it is called, that is what determines how costly the money is, the benchmark rate, and from there emanates everything else. You can keep on lowering the rate, but there comes a limit beyond which you cannot really lower down the rate. So it is here that the quantitative easing as a weapon of monetary policy, as an instrumentality of monetary policy, is unleashed by the central banks, or in case of India, the Reserve Bank of India. So what the Reserve Bank does is purchases government securities, all right, that it does so in the open market operations also, but it is not only the traditional government securities. There are other things like corporate papers, like corporate fixed deposits, like securitization of securities, like mortgage and housing based securities and so on. The Reserve Bank also takes the opportunity of buying those back. So when it buys those back, then what happens is that the entities, the corporates, the companies, the corporations, the non-banking finance companies, they get their money back. And since they are buying, the prices of those securities may go up. At the same time, the yields come further down, and the confidence of the market in those securities also increases. Now, why did the US Fed really buy those housing securities or the mortgage-backed securities, even though the asset prices or the underlying asset prices had gone below the market value of the prices? That was really to boost the confidence of the market that if the US Federal Reserve is buying those securities, then there is nothing wrong with the system. We are going to tide over a choppy storm which has hit the ocean, the economic ocean, but it is not something which is going to lead to a deluge. So therefore, quantitative easing is much bigger in magnitude than the open market operations. It is generally used in extreme circumstances where lowering of the bank rates by the central banks have not worked, and it is extended beyond the traditional government securities or the treasury bonds which the banks hold or the public holds. It goes beyond to corporate paper, corporate debt, and so on, non-banking finance companies. So quantitative easing, friends, is the ultimate weapon of injecting liquidity, of boosting confidence, and also going beyond where mere cut in interest rates works. So this, friends, is the talk for today as an instrumentality of the Reserve Bank of India to tackle a slowdown. We have not yet done it in the COVID scenario, but maybe it is coming in case growth doesn't pick up, in case the bank lending doesn't pick up, and people are just holding on to cash under their mattresses, so to say. So have a great day, and if you feel that this little talk or the series of these little talks is going to be of any value to you or your friends, please do not hesitate to comment, share, subscribe. Have a great day.